Bruce, I'll let you take it over.
Oh, good for you.
I'm gonna keep one.
Of course. So you know what the heck you're saying?
I can remember myself. Well, good morning, everyone. I'm gonna hit a few topics and hope that I don't infringe too much on whoever came before me or whoever came after me. So if I say something that seems redundant, please don't hesitate to correct me. I sit down because I think better while sitting on my butt, so you can hit me with any questions as we go through. I'm gonna hit just a little bit. Really, the things I'm gonna talk about are based on my experience of having worked with clients over the last few years as a number of the rules have changed and some of the things that I have seen. Before Dan sneaks out, I'm actually gonna give him full credit for one of the key things I'm gonna go over here in terms of qualified distributions, because if it weren't for him taking and giving me some of his patient understanding with how deductions work, I wouldn't have understood why qualified charitable distributions were so important to the average person. So thank you, Dan, for helping me be a little smarter.
And it's not because you're speaking, I do have something to do with you.
No, thank you, Dan, but I know it's totally because I'm speaking. Dan sat down one time and explained to me how standard deductions work. So when I talk about qualified charitable distributions just a little bit, it'll be because really how standard deductions work make that an important thing for particularly everybody. So I'm going to just hit a little bit on qualified charitable distributions and why they're so important to just the average person in the advent of an RMD world from retirement plans. Now, you know, the background is starting a number of years ago, we go back to the 70s and 80s, certainly that throughout most of my career as a financial advisor. We did a big shift 20, 30 years ago, 30, 40 years ago, from pension plans being kind of an underpinning way that we planned for retirement to 401k plans, 403b plans, qualified retirement plans being kind of one of the core ways that we save for and fund our retirement. So now most of us wake up with 401k plans, IRAs as being kind of a key thing that we use to have to fund retirement plans. And as a result, now we wake up and one of our major assets in life are IRAs, 401ks, 403bs, all these kinds of qualified plans. And they are kind of a big deal for us in terms of not only funding our retirement, but can be pretty important in terms of how we fund what we do with any charitable intent that we have throughout our lives. They are, without a doubt, when we think about what we want to do charitably, the type of asset that we should think of first. If we're doing gifting to our churches or any other charitable entity, they should be the first thing that we think about. How can we fulfill that charitable intent with my IRA? How can we fulfill that charitable intent with my 401k, my 403b, whatever it is? Because the tax consequences of doing that are so much more efficient with that type of an investment. Qualified charitable distributions don't kick in until we're 70 and a half. And I know Homer is well under that age, and so Homer, maybe in a couple years you can holler at me and we'll talk about it. But so qualified charitable distributions don't really kick in for us until we turn 70 and a half or older. But essentially, many people wake up every year and you start getting this little notice from your financial advisor that says you have an RMD. Now, in today's world, you won't be getting that notice until you're 73, but once you're 70 and a half, this can start coming into place. You don't necessarily have to get an RMD notice before you can use a qualified charitable distribution, But once you are 73, you will start getting these annual RMD notices, money that you have to take out of your qualified plans every year. That money is money that if you don't need it in that year, or you don't expect to need that money in a future year, that's a consultation you would have with your financial advisor. Hopefully your financial advisor is better looking and smarter than I am, so that you can sit down with them and have that conversation. But that's money then that you should think about. Okay, I want to give some money to my church. I want to give some money to some other charitable organization. That's a good piece of money to have go for that purpose. Now, how should I do it? 99 times out of 100, you should be doing is what's called a qualified charitable distribution. That means you're telling your financial advisor, of this money that I have, I want you to send it directly from my IRA to the church, to the Humane Society, to the community foundation, to wherever you want it to go directly from my IRA. Why do you want it to go that way? You don't want to receive that money directly. You want it to go directly to the organization, because if you don't receive it directly, then it's never reported to you on a 1099. I do have a little illustration that we'll be able to look at later, but the bottom line is, and that's what I was referring to that Dan had to walk me through. A few years ago, they increased what is called the standard deduction. This used to be we all itemized our deductions and we tried to jack up the number of itemized deductions we have, but they increased what's called the standard deduction. So most of us, many of us, will never have enough itemized deductions to exceed the standard deduction. So therefore, in a world where I received that income from my IRA and then turned around and donated to the church, what am I doing? I'm receiving the income and then I'm turning around and donating it to the church and taking a deduction for that donation. Sounds good on its face, but taking that deduction means I'm itemizing my deductions on my tax return. If I have that money go out directly to the qualifying charity, I'm never having to itemize that deduction. So the illustration I use in the handout that you'll be able to refer to is, if I have $60,000 worth of income, I take the distribution, so now I have of $10,000, so now I have $70,000 worth of income. I then turn around and write the $10,000 check, and then itemize and take my $10,000 deduction to try and get myself back down to a $60,000 income. And I'm a single person and I get a $14,000 approximately of standardized deduction. I really haven't done myself any good, because all I've done is used up what I would have gotten as a standard deduction. So therefore, having that money go directly to the charity means my standard deduction, I'm going to get to use the full thing. And that illustration is going to walk you through the math of being able to do that. Now, speaking of smarter, better looking people, Jack Bessie's just entered the room, so let's all turn and look at him as he comes in. But, in the biggest of pictures, we don't have to wait till we have RMDs necessarily to do that. RMDs can be satisfied with these charitable contributions, but once we turn 70 and a half, we can start looking at our IRAs as conduits for funding charitable contributions. We don't have to recognize income if we're reaching out to the financial organizations where we have IRAs and having them send that money directly to the charitable entity where we want money to go. So whenever we're sitting down and considering what our charitable intent is for a particular year, once we're 70 and a half, we should be looking at those retirement accounts and saying, is this a piece of what I can or should be doing? Because ultimately this is going to be a piece of taxable income that I need to be looking at, and I would argue that that's a piece you should be looking at before you're looking at strategies like donating appreciated securities. We're not talking about that today, but that's another strategy we look at across my client base when we're trying to do charitable gifts. So any of my clients that's over 70 and a half, the first thing we're gonna look at is, do we have IRA accounts? Are we gonna use any kind of qualified charitable distribution? There are limits. So first of all, I have to be 70 and a half before I can think about it. Second piece, I can't do more. The 2004 limit, this is an inflation adjusted limit, so we'll get new limits every year. The 2004 limit is $105,000, so if I want to do more than that, then I got to look at the other things. But first we're going to look at IRA qualified charitable distributions. Then we're going to look at donations of appreciated securities. One of the little provisions you do have in terms of qualified charitable distributions that you can do is you can do once in your lifetime up to $53,000 can go to an organization that supports what are called gift annuities. Gift annuities are a way where you can take up, I think, and that's a number that will go up. I think it's also indexed to inflation over time. But a gift annuity is an instrument or is a process where you take a lump sum, you gift it to an annuity, and in exchange they are making an income stream payment back to you on an annuitized basis over the remainder of your life or for a specific period of time. I'm not going to go into it a lot more detail than that because it's arranged specifically with the organization with whom you are arranging that annuity. But if you think that's something, oh, I'm willing to make a substantial gift of, many organizations will have limits around it. For example, they might say, well, we will do them, but we won't do them in amounts less than, say, $10,000 or $20,000. They might have a limit on it. There can be some things that you need to be aware of. You might not want to do gift annuities with every particular charitable organization walking around out there. But if you think about it, saying, I'm willing to do a larger gift, but maybe I want a little bit of income stream remaining out there for a period or a lifetime period sitting out there, it might be something to consider saying, okay, yeah, I'll take a specific amount out, do it as a lump sum. That is up to $53,000, a kind of a once in your lifetime type of option. You can also do qualified charitable distributions with inherited IRAs. Again, you just have to be over 70 and a half. You can't be 50, inherit an IRA, and then do charitable qualified distributions with that. But if you're over 70 and a half, you inherit an IRA from a parent or other family member or anyone for that matter. That's also an instrument out there that you can utilize to do qualified charitable distributions. Something to think about, because if you inherit an IRA, you typically in today's world have a 10-year period with which you have to do something with that IRA. So that can be a good tool for saying, okay, I didn't expect this. I do have some charitable things I want to accomplish, and this is a great way to take advantage of that. Sometimes when I get on a topic, I ramble or I say things in a way that's not particularly clear. So, does anybody have any questions that are popping up as we kind of hit this topic? Yes, I will take questions from anyone but Margaret Pierce. If anyone else has questions, please feel free to raise. I'm sorry, Margaret. Yeah.
I have
Yes.
one comment to make about.
Okay,
rejection.
comments are fine. Questions and.
This is experience.
Yes.
Knowing that it is 70 and a half, and most people are on Medicare by that time, right? And you understand what Medicare premiums are based on. So if you have acquired, working all your lifetime, and you've put into an IRA or 401k, you've acquired some pretty good funds in there. And if you took the money out and then made the deduction, what you've done is raised your AGI.
Right.
And the AGI is what they base the Medicare rate on. And so especially if you're down to one person, you have the real potential that will throw you into a new Medicare rate.
Right.
So that, for over 65, that is really a key reason.
Right, yeah. It not only keeps your income taxes lower, what Margaret is pointing out, that by doing qualified charitable distributions, it can also keep the taxability of your Social Security income lower, and it can keep your Medicare premiums lower by keeping you at a lower income rate. Yeah, thank you, Margaret. That was
Margaret is a
important.
retared trust officer, and in the past, we worked with this gentleman.
Yeah, although I do pretend not to know them, as you can tell. Yeah, so.
That track runs 2 ways.
You learn all those things when you get over 65.
Yeah, you do. Yeah, or when you work with people over 65. When you work with people over 65, they have a habit of telling you about anything that costs them money,
Yeah.
right? It kind of comes up. So you do get to learn about those things one way or the other. So perfect. So we've hit on a number of those things. All those things seem pretty clear, kind of right off the top. The other thing I want to hit, because we don't have a ton of time, and this is something that I feel like doesn't get talked about enough, or hasn't resonated enough over the course of my career. I spent a number of years working as a trust officer for both the NBC Bank organization, which is now owned by Wells Fargo. If you work in the bank organization, you get to refer to prior banks that you used to work for as now being owned by other bank systems. So I never worked for Wells Fargo, I just worked for banks that are now owned by Wells Fargo. I used to work for Platte Valley State Bank, which is now FMBO, so you get to make some of those references. As a trust officer, did a lot of estate planning and trust work back in those days, now with the 5 Points Bank system. But I do think that one of the things that really has gotten lost or doesn't get utilized as well as it should have is the understanding of 401k plans, IRAs, and naming charities as direct beneficiaries of those kinds of assets when we die. So now the way the world works, when I'm naming my son or daughter, when I die, the major assets in my estate are going to be IRAs, 401k plans. That's just how, throughout the course of my lifetime, most of my assets have been accumulated. My other assets, when I die, are going to get a step up in basis. Those are going to be the best ones for my children to inherit. My 401k plans, my IRAs, unfortunately, when my children inherit those, they're going to be stuck with this 10-year rule. They're going to have 10 years with which to empty those accounts and pay income taxes and all that money as it comes out. So they're going to recognize a pretty significant income tax burden on those. So what's really going to be the best option for my wife and I when we sit down and work through how we want to implement our charitable intent out of our estates is to say, no, what's going to happen is for any of the charitable things we want to accomplish, that's going to happen directly out of our IRA accounts, directly out of our qualified retirement plans. And I'll distinguish just a little bit. So Roth IRAs, Roth accounts, I'm going to set out separate because yes, our children will only have 10 years to empty those accounts out, but there's no income tax consequences as a result of those. So not such a big deal. Qualified accounts, traditional IRAs, traditional 401ks, very big deal, big tax consequences. We're very fortunate, at least at this point. Our children have reasonable careers, so there will be significant income tax consequences. So to the extent we have charitable intent and things we want to accomplish, having those assets go directly to charities is going to be the best possible thing. Those charities will be able to inherit, $10,000, $50,000, $100,000 would mean a far smaller amount to our children, and it'll mean $10,000, $50,000, $100,000 to the church, to whatever entity we choose to leave those to. And so finding a way to make those direct beneficiary designations out of those plans. Now, I will tell you quite frankly, it's a ton easier out of an IRA than it is out of a 401k plan, and really the mechanics behind that are many 401k plans are picky about what they will accept as beneficiary designations. IRAs can be far more accepting of what they will accept and how they will accept beneficiary designations depending on who the custodians are. 401k plans just can be a little more difficult in that regard, but finding ways to name charities out of those entities is by far and away in my mind, the best option for fulfilling charitable intent with money and maximizing the tax impact for whatever portion of charitable intent we have. I kind of put that out there as a side note, and I'm not trying to expand too much and getting into other speakers and estate planning, but I did want to put that out there because I just feel like, boy, over the course of my career, I just have not seen enough people do that. I don't see estate plans come in with enough of that done, and so I just put that out there because I don't know if people aren't having that conversation with their attorneys. I don't know if they just aren't contemplating that well enough. So when I have a group that is forced into an enclosed room alone with me and has limited abilities to run, I just try and throw it out there. So please consider that in terms of a piece of what you do, because I do think that's by far and away the best particular option. So I've hit a limited number of topics. I've just tried to throw it out there. Now, are you going to ask a question or are you going to make a comment?
Can I name a contingent beneficiary for a charity?
Yeah, of course.
It's like we were talking about if a church closed, so you could actually name a contingent too in case it did.
Sure.
I was curious.
Yeah. Yeah.
Question for you, and I don't know if you can answer this or not, but you talked about
No.
This came to my mind. IRAs and 401ks. What about a significant life insurance payment to our children? Is that going to tax them in the same way? Where does that fall into the categories?
So life insurance is a completely different type of thing. Life insurance is typically not subject to income tax when those payments are made out. So I would treat that so that's not a qualified asset. So I'm going to treat that more like I'm going to treat, think about it more like a Roth, right? There are no income tax consequences as a result of that. Now I can't say that with a blanket because there are structures of how insurance is owned that could put a completely different spin on what I'm just telling you. But I'm saying as a general rule, what's going to happen is you went and bought a life insurance policy and you funded that life insurance policy directly with money out of your own pocket, and you named your child as a beneficiary of that life insurance policy, and said that when you died, you had a benefit that was payable to them, and there are no income tax consequences as a result of doing that. And in large case, that benefit is Jack, hit me if I'm wrong, but the proceeds of that not really even includable in the estate tax valuation of the estate. So
exactly, you don't list it in the inventory. You don't have to pay inheritance tax on it
right.
in Nebraska.
Right. So there are even some when you start working with estates where you're worried about a federally estate taxable estate, there are things that we will do, unique things that we will do with life insurance, because there are some unique things you can only do with life insurance. So in terms of life insurance, I would not think of that directly in terms of estate planning, except to the extent of, here's to me, if I had a client sit down to me, here's where life insurance factors into something. I have been making a consistent recurring gift to a charitable organization to support a mission within that organization that has been critically important to me during my membership period or my active involvement. And you know what? That activity, that function, that whatever within that organization is just central to what I consider one of my purposes in life. And upon my death, I want to make sure that that mission is carried forward beyond me. And when I sit and think about it, I have all these other things that my estate is going to go. I want this to go to my children. I want that to go. I don't have anything else that I think is going to go to the charity, to my church, or to whatever it is to support that ongoing mission. And so I decide I'm going to go buy a life insurance policy that a lump sum is going to the church to fund that mission. That's when I would say, okay, you know, one way we can replace to the church or to whatever charity it is, to a lump sum to fund that ongoing mission. One way you could do that is with a life insurance policy. It's not the first thing I would think of, because I would kind of categorically say, wow, if you had other I'm going to be looking for other assets to do that with first, but I wouldn't rule it out as a potential possibility of way to do that.
Thank you.
Yeah.
I had a question on the QCDs. It says that it can't be from 401k plans, but through my employer, I do 401k and Roth IRA. Can it come out of that Roth IRA?
No.
No.
So you wouldn't do Roth IRAs do not have any RMD requirement associated with them. So you wouldn't do a QCD out of a Roth.
Yeah.
So you just throw that away.
Okay.
And qualified retirement plans don't allow it.
Okay.
So what I would do if I had a client in that situation is we would roll the money over from the 401k to an IRA, and we would then do the QCD.
Okay. Just want to make sure I
Yeah.
understand that right.
Any other questions for Bruce? Just so you know, the things he's talking about, charitable gift annuity, all those vehicles is what we call them, we can help you with that at the Nebraska United Methodist Foundation too.
Perfect. Great. Have I said anything really stupid?
I'll send it
Normally I
very
do.
smart.
Normally I say something. Oh, Homer, come on. Well, I do appreciate all your time this morning, and if you